Classical chart analysis. Classical charting began, I mean, that's how technical analysis began, and it began a long time ago with a man named Charles Dow, who was editor and owner of a little broadsheet that went out called the Wall Street Journal. He came up with this concept: averages discount everything, meaning everything is reflected in prices. He never wrote a book, but he wrote many editorials, when after he died, the magazine was bought by the people by the family who eventually sold it to Rupert Murdoch a few years ago. They owned it, a family from Boston that owned it for decades, and they hired this man named William Hamilton, who did write a book, and it was really the first book on technical analysis. So the revolutionary concept was that prices reflect the sum total of knowledge about the market. Smart money and dumb money, slow money and fast money, everything is in prices. And if you only follow prices, you can tell which way the market is going. You don't have to read balance sheets. And out of it grew this whole classical technical analysis, trend lines, heads and shoulders, double tops, double bottoms, rectangles, etc., etc., etc. To me, it's absolutely, totally, and completely dated. Dated because when you look at a chart and you start doing things like, is this reverse head and shoulders? Oh, is this a trend line? Or no, this is a trend line. Oh, is this a trend line? Or is this you know, it's so subjective. And I have this terrible problem, my fingers shake when I trade. And when I'm bullish, they shake up when I try to draw a trend line. And when I'm bearish, they shake down. So to me, this classical charting is so wildly subjective. It's dangerous. The market doesn't know diagonals. I mean, if you put on a trend line like that, and now you change the formatting of this chart, the trend lines will have to change. There are only two things I really trust and use in classical charting, and use all the time. I think horizontal lines matter. Horizontal support and resistance matter. They matter because people remember where prices bottomed out before. And when prices come back to that level, they're prone to buy. Same thing with the tops. Another thing I believe in a lot are false breakouts. So horizontal lines and breakouts. Here's a chart of Tesla. And it's a weekly chart. It covers just about 2 years of trading. Here is a weekly chart that covers all of history of Tesla, which is about 4 years old. So some brilliant genius bought it at $20. And of course, it's very tempting to think that we can hold it from 20 to 200. The problem with this thinking is this, that here Tesla reached 194, and then over the course of many weeks, it slid down to 117. So if you have 1,000 shares of Tesla, and it's sliding from 197 to 117, $80 down, are you still holding through the drawdown? I highly doubt it. But that's the problem with long-term holding, and we'll talk about it again later. But let's get to what I mean by a false breakout. So Tesla establishes this peak, so it breaks out, continuous rally, pulls back, seems to break below the breakout line, starts on a new rally, and look what happens. It breaks out to a new high, spends 1 week above it, second week above it, and sinks back on the third week. And this, to me, is where the false upside breakout is completed. Tesla tried to break out to a new high. It broke out to a new high, And now during this week, it identifies it as a false upside breakout. And that to me is a very, very, very valid concept, right? It tried and it failed. Well, what it's likely to do next after it failed there? Try it again? Probably not. It's more likely to continue in the opposite direction. So this is a pattern. These are two patterns I really look at the markets for: support, resistance, and false breakouts. And my favorite form of a false breakout is called a kangaroo tail, where there are two fairly narrow bars bracketing a very tall bar. And kangaroo tail or a finger, the market throws out this long line, tries that price level, and then it says, nah, don't like it, and goes the other way. Here's the chart, Canadian dollar. Look at the kangaroo tail, look at the false downside breakout, look at the false upside breakout. Look at this, 2008, Canadian dollar crashes and burns, rallies, and then in March of 2009 drops to a slightly lower low. Spends no time there at all, false downside breakout. And a beautiful rally begins. In 2010, that rally ends the same way. Top, pullback, breakout to a new high, and failure. You can't miss them. I mean, they jump at you from the screen. You don't have to squint. If you have to ask yourself, is there a false breakout? There is none. Because when there is, you can't miss it. Let's get a current chart. What do we see? The chart of the Canadian dollar. The low in April was 88.07. You see false breakout and the rally begins, right? Now this low was 87.12, and low last week 87.12 again. I actually don't like that. I want to see a break of the previous low. The fact that the low is holding, it's too neat to be true. But just as an example of a pattern I pay a lot of attention to. So support and resistance, they make logical sense. People remember prices. False breakouts make sense. The bulls tried and failed, or bears tried and failed. And of course, my favorite unmissable type of a false break is this kangaroo tail. And you can see lots of them on the chart. Long bar, and very often trends reverse at those bars. Facebook, daily chart. Sort of kangaroo tail, reversal, false upside breakout. And to me, these are patterns that once you see them, you don't have to squint ever again to find them. False breakouts, kangaroo tails. We analyze market psychology. We try to figure out how this crowd is shifting, how this crowd is moving. And it shows that the crowd was very bullish. And by the end of this bar, that bullishness failed. Well, let's sell short. Markets go both ways. They go up and they go down, and they spend 2/3 of the time going up, 1/3 of the time going down. Now, some people don't like shorting, and that's perfectly fine, but you got to sell short to say, I don't like shorting. Wait, yes, please.
The most recent lows in the market in October, was that kangaroo tail?
Let's, in the market, you mean like in the stock market?
The SPY or?
Let's take a look. The weekly chart of the S&P. This was one substantial kangaroo, wouldn't you say? It wasn't a little kangaroo. And at the time of that kangaroo tail, there was a cluster of other signals, which we'll discuss. But it's a very good call on your part that it was most definitely a kangaroo tail. And these kangaroo tails, they tend to move prices for a while. So once you see that kangaroo tail, you have some, the move is not over the day after the kangaroo tail. Furthermore, I'm starting, with this chart, I'd like to introduce this concept about which we will talk in detail later, that markets have to be analyzed in more than one time frame. Strategic decision on the big time frame, tactical decision on a shorter time frame. So this kangaroo tail we're looking at here is on the weekly chart, right? Well, now we have a field day ahead of us. Let's switch to the daily and look for buying opportunities. You see what I mean? Strategic and tactical. Strategic, kangaroo tail. Tactical, where to buy and where to sell.
Would you look at the DAX also for kangaroo tails there as well?
Let's take a look. I want to look at it on a weekly basis. There is not too much doubt about this animal, right? Yes, there is a kangaroo tail on it. The patterns I'm showing to you are universal because they reflect human behavior and how humans act, especially under stress. Markets provide plenty of stress. You know, people speak different languages, live differently, but whenever we get our fingers caught in the door, we'll scream the same way. You know, it doesn't matter whether you're in New York or in Hong Kong, and whether you had 2 or 22 years of schooling. You know, you know, civilization is just a thin veneer on the whole thing, and that's what comes out in the markets. And so these patterns, they work worldwide. I traded in Australia, I traded in Singapore, I traded in Russia, obviously I trade in America all the time. I like trading only where I live because I don't want to go into a different time zone. When you trade, you try to pick other people's pockets, and they try to pick yours. And it's tough enough when you're awake, but when you're asleep, and they're picking your pockets. So that's why I look at the DAX once a week. But when you ask me, does this pattern work in DAX? Pull up the chart, of course it's going to work in it.
In terms of timing, though, I mean, we're looking in hindsight, right?
Hindsight is a wonderful time frame.
Right, but when in real time, you're not going to see that kangaroo tail at the moment when
No.
it's going down. So
Well,
how does that work?
If you're a very, very serious professional trader, you will recognize it during that bar. If you visualize this trend, just imagine the DAX is cracking.
Yeah.
Week, huge week down, and the second huge week down, right? So forget about what's on the right edge. Imagine this is the last bar, and it just looks horrible.
It might keep going down.
It keeps going down, and then it stops going down, and it starts pulling up towards the end. Well, it's confirmed as a kangaroo tail, not during this week, but during the next bar. You have to have front bar, during bar, and after bar. And it's the after bar that you have a very clear confirmation. If you're very, very good, you will start recognizing it earlier. You will probably switch from the weekly to the daily chart, etc., etc. But the complete classical pattern will not be finished until the bar after the kangaroo tail.